of Nomura joins in to talk about that. Paul, morning. Thanks very much for joining in. Which camp do you stand in? The camp which believes that this is a powerful bear market rally and will run into headwinds very soon? Or do you believe that the green shoots that people are talking about are actually paving the way for a more durable recovery in global economies and markets?
Well, I think one thing and one thing only is driving asset prices right now, and that's policy. Policymakers around the world are responding to the immense deflationary downturn that we've seen globally with unprecedented, never seen before, extremely powerful stimuli, both in central bank balance sheet expansion and in fiscal expansion, which are, according to what we have done recently, something like 11% of GDP globally. In the case of China, it is 19. In the case of the U.S., it is around 14. So we're talking about, even for the U.S. and China, about 20% of GDP for China, around 14% of GDP for the U.S. So we're talking about a total stimulus expansion of around $6 trillion. And we're talking about governments which are taking the risk away from investors and giving it to taxpayers. That taxpayer bill is going to come within 2 years, but that taxpayer bill is not an issue now. So I'm of the camp that this rally can continue for a while. It's all about policy.
Paul, good morning. The other thing that has been a takeaway with the 6-week rally for the markets is that perhaps most equity markets have put a durable bottom in place. Would you go with that theory as well?
Yeah, I'm not a big fan of technicals, but if you look at technicals, we've been putting in place, I think, a bottom for a lot of markets in Asia in particular for the last 5 months. And in fact, we have a sort of a reflation portfolio of stocks, which includes property and banks and coal stocks, two of which are HDFC Bank and DLF in India. And those are all showing decisive bottoms, and in fact they're breaking out of their 200-day moving averages right about now. And so that's something that a lot of people look at, is when these stocks begin to break out of their 200-day moving averages, which is one of the first times in a year that stocks have been able to breach those 200-day moving averages.
Fundamentally speaking, when you map valuations, Paul, how much upside can you justify for most of the Asian markets from these levels?
I think markets like Australia is expensive. Some of the large caps in Malaysia are expensive. Some of the large caps in Hong Kong are expensive. A few of the large caps in Singapore are expensive. But generally speaking, I think the Asian markets are very cheap. For instance, I'll give you an example of our property portfolio in Asia is trading at about a 36% discount to NAV. It's trading below book. So this is a portfolio to me which is not expensive. We're looking at banks trade ICBC in China trading at book. That is not expensive. So the bank's portfolio looking at something like 1.3, 1.4 times book. That is not expensive. Looking at coal stocks trading at 1.1, 1.2 times book. A lot of these stocks, don't forget, are down. They were down 75, 80%. They're now down 65, 70%. Even though we've had a very big move, in percent terms, they're still down 60% plus for most stocks in the region.
When you say this rally has been all about policy, Paul, is it the policy that's been emanating from the U.S. you're talking about, and the banking plan and the stress test plan that you took most heart from, or something else?
Well, no, it is the U.S. As I pointed out earlier, the startling thing to me is that the largest, most aggressive central bank and fiscal easing program in the world is in China. So China's program is far and away the largest, the most aggressive in the world. It's above 20% of GDP. The U.S. is around 14. The European Union is around 9% of GDP, both in terms of the central bank plus the fiscal stimulus. The UK is around 5 or 6% of GDP. The rest of Asia is around 3 or 4% of GDP. So there is a combined element to this, but far and away, China first, the US second, Europe third, in terms of the stimulus. So it's global.
What's your take on the Indian market, Paul? Do you find it cheap or expensive relative to the rest of Asia? And how are you positioning yourself aside of those two stocks?
I'll give an example, for instance. Yeah, I think that I've been talking about this for a long time. I've been very bearish on the region and very bearish on India in particular. I think there is a change here for a number of reasons. One, I think India did become very cheap. The property stocks, if you index the property stocks, they were down 93%. This is one of the worst property stock performers in the world was in India. The banks were among the worst performing bank index in the world in dollar terms, only beat by Hungary, Russia, and Austria, and of course Iceland. And so besides Iceland, Ireland, Iceland, Austria, and Russia, India was the 5th worst performing bank index in the world. So Indian stocks were absolutely clobbered. And what happened at the same time is that the rupee devalued and China went up a lot. So relative to China, India is extremely cheap in terms of the currency move, but also in terms of the catch-up. I think India is playing a big-time catch-up to China right now. And so in that sense, on a relative basis, India is actually looking very cheap.
What kind of tactical call are you taking then on both those sectors now, Paul? Real estate and banking, for example, are you looking to diversify a little bit or top up for your existing holdings?
No, we would be, definitely we'd be topping up on the existing holdings. We would not be diversifying. We have 2 stocks in Singapore, 2 in Hong Kong, 1 in India. We have 2 in Malaysia, and we have 1 in Taiwan and 2 in China. And so we're happy with that. Of the coal stocks, we have about 6 coal stocks, and of the banks, we have 7 banks. 1 in China, 2 in Hong Kong, 1 in Singapore. We have HDFC Bank in India, Fubon Bank in Taiwan, and no Korean bank exposure. And we're happy with that going forward.
What are your thoughts on steel, which has had a magnificent pullback rally this last 1 month? Are you a buyer of that story?
Well, that's a good point. We've been that's been a tug of war internally with many of my colleagues internally at Nomura. I like stocks that have an asset base which is landed. Coal stocks are what we use to cook our food. Plantations and land is what we use to grow our food and live where we eat our food. Steel assets are a wasted asset. They are a depreciating asset. And so for that reason, we think that steel stocks are my view is that steel stocks are a bit of a value trap. They have been racing. I know that some of the steel analysts have upgraded their views on the Japanese steel sector. I think I would rather play an asset base which has a landed asset structure which is capable of reflation rather than a capital-intensive asset structure like steel, which is a wasting, depreciating asset. So I'm not a buyer.
The ascendance has been the Sorry, please go ahead.
No, I'm finished. That's
okay. The ascendance has been the sharpest fall for emerging markets on the one hand and commodities on the other, and many have put that down to the fact that risk aversion has increased. There's money waiting on the sidelines, and these are probably the markets people want to chase right now. Is that what you're seeing, that there is money and it's probably going to track markets like India for a while?
I think there's a fundamental, it's not just a matter of funds flows. We've said this many, many, many times. There is a fundamental difference between what is happening in the West and what is happening in Asia. There is an unprecedented, severe, dramatic banking crisis in the West. There is not one single country in Asia experience a banking crisis right now. There is not one single government who is going to be forced to raise taxes in Asia in order to pay for a bank bailout. Not one. And every single Anglo-Saxon country is experiencing a very deep and very broad banking crisis, which is going to result in higher taxes later on, and later on also higher inflation. The leverage levels in the West are much, much higher than anything that we see in Asia in general and in emerging markets in particular. Those leverage levels in Asia are around 14 times. The leverage levels in the West are at 32, 34 times. This deleveraging process is going to be a very long, painful process. There was